As a business manager, it's important that you understand how ratios work. They are financial measures that determine the health of a company. Quick ratio, for example, in the document on the left, measures the company's ability to meet short-term obligations or bills that are due within a year. And it's based on the liquid assets that a company has. Do they have enough items that could be quickly converted to cash to be able to pay their bills? So the higher the quick ratio, the better the position of the company. 0.38, not that high. So this document on the left shows you how to do each one of the ratios. It talks about why each one of the ratios is important, but I also want you to note the numbers that each one uses. So current assets, for example, is $4,719. We come down to the balance sheet. Even if we don't know where exactly to find it, we can look for that number. Okay? And we can use that as a reference looking at other companies' information. So the document on the right, Avon Products, looking at its balance sheet, we know where to find current assets. So if we come here, we know that this row has current assets. So when we want to figure the quick ratio for Avon, we know that it's current assets minus inventory, and that's here, divided by current liabilities, which is here. And if we're not sure where to find something, we can use these numbers, go to Sally's Pet Store numbers, and match them up, and then we'll be able to find them on the more complicated balance sheets at other companies. So I have this for you. Both documents work together to help you. What you're going to do is you're going to complete this financial ratios worksheet so that you see how ratios work and you start analyzing them for purpose. This first step requires one additional piece, that you determine the common size ratios. What common size ratios are is when you divide various numbers by a common number. So if we come down to the income statement for Avon right here, I didn't want you to have to wait while I typed everything in, so I've already got these items in, and if you look over here, you'll see that the items match. So in a common size, it's different items with a common number, and the total revenue is the common number. So we have cost of revenue divided by total revenue, gross profit divided by total revenue, net income, again, divided by total revenue. So of our total revenue, 38% goes to cost of goods sold, also named cost of revenue. 62% goes to gross profit. And when we get all the way to the bottom, well, obviously they're losing money. Less than 1% is still in the game. So when we come up here, we read the sentence and we fill out and put in the blanks based on the numbers that we have figured ratios out for. Avon Corporation net profit, sometimes called gross profit, like it is in Avon, as a percentage of sales, sometimes called total revenue or total sales. So that's what percentage of the total revenue is net profit, also called gross profit. So we take 6182,500 divided by 9955000, and we get 62%. So as you're working on the other items, refer back to this document on the left to help you remember where to find the information you need. And then as you get to the bottom of each section, it will ask you questions, and I want your input. This question, for example, based on the figures you calculated, do you feel that Avon Corporation can meet its short-term obligations? If so, why? And if not, why? So, is its numbers, the trend for its numbers, high enough that you feel the company should be able to meet its short-term obligations? And why? If you have any questions, let me know.